What is the moving average in trading? The moving average is a technical indicator that investors and traders use to determine the trend direction of securities. It is calculated by adding up all the data points during a specific period and dividing the sum by the number of time periods. Moving averages help technical traders to generate trading signals. Why do traders use moving averages? A moving average (MA) is a stock indicator commonly used in technical analysis, used to help smooth out price data by creating a constantly updated average price. A rising moving average indicates that the security is in an uptrend, while a declining moving average indicates a downtrend. So in the graph you can see I have marked all the moving averages. These are the moving averages I use for my intraday trading. So this is the 9 EMA exponential moving average. This is the 21 EMA. This one is the 50 EMA. This is 100 EMA and this one is the 200 EMA. I will show you more charts with EMAs. So this is the 9 EMA. This is the 21 EMA. This is the 50 EMA. This is 100 EMA. And this one is 200 EMA. Similarly, I will show you one more chart. So this is the 9 EMA. This is the 21 EMA. This is the 50 EMA. This is the 100 EMA. And this is the 200 EMA. Exponential moving average versus simple moving average. What is the difference? Exponential moving average versus simple moving average. An overview: exponential moving average (EMA) and simple moving average (SMA) each measure trends commonly used by technical traders to smooth out price fluctuations. The exponential moving average (EMA) meaning is a technical indicator that determines the direction in which the price of a security is moving based on past prices. Therefore, EMAs are lag indicators that don't predict future prices but showcase the trend that the stock price is following. How do you use an EMA indicator? Trend analysis using EMA. When EMA is below the price and upward sloping, it generally signifies bullish momentum but with increased resistance. Conversely, if the EMA is sloping downward and is above the price, it may suggest a bearish trend. The primary difference between an EMA and an SMA is the sensitivity each one shows to changes in the data used in its calculation. The exponential moving average gives a higher weighting to recent prices while the simple moving average assigns an equal weighting to all values. Key takeaways: the exponential moving average gives a higher weighting to recent prices. The simple moving average assigns an equal weight to all values. As with all technical indicators, a trader cannot use one type of average to guarantee success. Simple moving average. The simple moving average (SM) is the most common type of average used by technical analysts and is calculated by dividing the sum of a set of prices by the total number of prices found in the series. A 20-period moving average can be calculated by adding the following 20 prices together and by dividing the result by 20. SMA is equal to $311 divided by 20 is equal to $15.55. So day 1 price is $10, day 2 $12. Like this, we calculated the simple moving average. Exponential moving average. Since the exponential moving average EMA places a higher weight on recent data than on older data, they are more reactive to the latest price changes than SMAs. The results from EMAs are more timely and usually the preferred average among traders. The EMA gives higher weight to recent prices while the SMA assigns equal weight to all values. The weighting given to the most recent price is the greater for a shorter period EMA than for a longer period EMA. For the 20 period example, 9.52% is the weight, but 18.18% would be the multiplier applied to the most recent price data for a 10 period EMA. Charting averages. So blue line represents the SMA and the yellow line represents the EMA. So this is a 15-day SMA and a 15-day EMA. Notice how the exponential moving average yellow line responds to price changes faster than the simple moving average blue line. You can notice here that the simple moving average is this line and these are the price fluctuations, but SMA is still stagnant here. There is very slow movement, but you can see the exponential moving average has already shifted towards the candles in the direction of the market. So this is the difference actually. Which average is useful for long-term investments? Traders with a longer term perspective consider the average they use because the values can vary by a few dollars, which is enough price difference to ultimately prove influential on realized returns, especially when trading large quantities of stock. What is a limitation of the simple moving average? Traders commonly agree that the new data better reflects the current trend of a stock. SMA may rely too heavily on outdated data since it gives the same weight to yesterday's price as the price of 1 year ago. What is the common period used for EMA calculations? The longer the EMAs of 50 and 200 days tend to be used by long-term investors, while short-term investors tend to use 8 and 20-day EMAs. The bottom line, traders use many technical indicators to evaluate investment opportunities and trends. The simple moving average SMA is used to see price trends and assigns an equal weight to all values. The exponential moving average EMA gives higher weighting to recent prices. What is the EMA strategy? The EMA strategy generates buy signals when the price moves above the EMA line and sell signals when the price moves below the indicator. These signals can help traders identify potential breakouts and entry points for trades. Thanks for watching my video. Please subscribe to my channel